Thank you, Blake. Dream
Thanks,
Team,
guys.
thank you for laying it all out on the court again this week. Welcome back to F.A.C.E, Dave.
Thank you.
How
You
are
guys
you?
are kind of clowns today.
I think it's
Daily, Dave. Daily,
Yeah.
daily. We are.
It's a coping mechanism, Dave. Humor kind of takes the edge off.
You have
The
to laugh in this
intensity
sort of
trading.
environment for sure.
Yeah. So, like I said before you came on, David, I remember you had a negative view of the market.
Yeah.
Before the big selling coming in April, which, I thought it was great. I was talking to someone else who uses seasonals, and April was supposed to be a very positive month for the market, where seasonally risk on, but it just goes to show you can't depend on just one thing like seasonality, or just one thing, the 200 and the 50-day. It's just another tool. And so, I'm glad when some of these tools don't work, so that people learn that they have to do the work. And it's not that as easy as, it's a bullish month for risk and just get long.
Yeah.
So
and particularly newer investors, I think, struggle. Their goal early on as a trader is to find that one thing, right? That thing where you just you can relax and just watch this one chart or this one indicator, this one tell, and then it's easy. And I will tell you, as you know as well, Dale, that it's not there. There's a lot of nuance to it. So over reliance or oversimplification ends up not being a great strategy. And this has been a humbling experience, a humbling 2022 for a lot of traders, for sure.
Yeah, buying the dip, which they've been programmed for
that's right,
a decade, at least.
Yeah.
So what do you see in here, Dave? Are we approaching some type of targets? I know a lot of people are talking about this 38-ish area, 38% retrace of, from the COVID low to the high that we had this year.
Yeah.
You think that's going to be enough for at least a bounce? We almost got there yesterday, didn't we?
So I was going to say we're within a rounding error of that 3,800 level. I mean, on my chart, I'm kind of keying in. It's around 3,815 or so is the actual level. That's if you take the March 2020 low and then the January 2022 high, that would represent a 38.2% retracement of the way down. And a lot of people pay attention to these levels. It's not just, my chart, but this is a pretty common technique in the technical community. So, if you took September 2020, which was sort of that big congestion phase, September, October of 20, before you had the rally that led into 2021, 38.2% of the way down of that was right here around 4,200. And we spent about 10 weeks kind of bouncing off of that level. So these are important levels that people tend to pay attention to. And I've heard it from a number of my peers in the industry to the point that I would say, as we get closer to that level, I would be banking on a meaningful bounce, but I would continue to think of it as you should be thinking of 2022 so far. This is a market in distribution mode. And I think, bounces are tradable bounces, but that's it. I think if you're looking for bottoms yet, you're probably a little too early. And you had mentioned it in the introduction, which I appreciate. The signs that we have been talking about with our viewers are, really started in November. That's when most things kind of topped out. That's when breadth topped out, momentum topped out. The NASDAQ, a lot of things did not make that new high in January that the S&P did. And so there had been signs of deterioration even in the fourth quarter of last year that have just been, continued to be reinforced through the course of this year. And I'm not seeing any meaningful improvement in those things that suggested the top going into the beginning of the year that would suggest any meaningful bottom yet, right?
Yeah. Okay. Where you've had a little pullback in yields here, Dave, do you think that's, the 10-year has pulled back about 40 bips and now it's trying to pop a little bit? And a lot of this has been interest rate pressure. Yeah. So I think that the hook might be everyone thinks if yields start to come down, that all is clear. But perhaps what it is a move into flight to safety, even though all the way down, both stocks and bonds went down together. In fact, the bond bear market led it? Could there
Yeah.
be, people saying, not a bad yield for a 30-year. I think I'll buy it.
So that is absolutely the case, and I listened just a little before you and I started talking about the dollar with the incredible run that you've had with interest rates going up so quickly. So in any sort of environment, what you learn as a technical analysis is to focus on extremes, right? There are healthy patterns or sort of consistent patterns of accumulation, and maybe the energy sector is a good example of that, like a chart like Devon Energy, which is this nice consistent uptrend. And then there are charts in clear distribution phases and things like communication services, kind of stocks like Disney that have just been in these downtrends. But then there are also, you're also trained to find extremes. Like at some point when a trend persists, it gets to the point where people start realizing, okay, hold on a second. The dollar's gone up a ton. All right, hold on. Bonds have gone down a bunch. At some point, just the valuation, just the cheapness or the richness of something will compel enough people to either take profits or to jump in. And I think you're right. I think as the equity markets become a lot more painful, I would still argue there are people that are still thinking buy on dips here for some reason. And at some point, I don't think we're firmly in that disbelief phase or in that, we're in the disbelief phase, which is, the market goes down and you don't believe it can go much lower. When, a true bear market is where there's this acceptance, sort of this, dismal acceptance where you recognize, okay, things just aren't going to improve for a while. And that's when you see people rotate into safe havens. And the fact that rates have spiked up to where they were in the end of 2018, which is around 3.25, that's the chart we have here. The fact that the dollar's had such a run, I think it's totally reasonable to expect a pullback in the dollar, to expect a bounce in bonds and a pullback in rates. But I would be thinking of those as counter trend moves within this longer phase, which I don't think is probably over yet.
Okay. And with rates coming down, a lot of people say, well, buy the semis because, and actually the semis seem to be a group that has been, as of late, showing some resilience. Are you getting any kind of signals that they're at least due for a bounce, SMH?
So, and I would start, I'll bring up the chart of the SMH in a second. The second panel on this chart, I think, tells you a great deal about why rates are so important for the question you just brought up, Dale, which is, if you look at value stocks versus growth stocks and compare that to the chart of the 10-year, it matches up pretty well over the last couple of years. And, and again, 6 months ago, it felt crazy to think that FANG stocks would just be cratering and energy stocks would be ripping to the upside, but that is indeed what we've been seeing, and that's a pretty classic move given the fact the rates are going higher. It's just and you had mentioned with seasonality, I don't tend to think of things in absolutes. I would tend to think of them more in terms of headwinds and tailwinds. So you have to remember that if rates are going higher, that's a headwind for growth stocks. It's just not a great environment because their growth prospects don't seem as attractive when you have rates going up like that. When rates come down, that's when it ends up being a better environment. So a counter trend move, if you see rates come off a bit, if you see bonds rally, I could certainly see semiconductors coming up. And in the chart of the SMH, it's lining up really well with sort of that second quarter of 2021. This was a nice big run into the beginning of that year. You sort of had that consolidation pattern before we resolved to the upside, and we're kind of retraced 100% back to those lows. So it's a reasonable place. You could expect a bit of a bounce here. So I think that's when I'm looking at stocks that overall I still think feel fairly weak in terms of the major indexes. Semiconductors have come off quite a bit, 100 points on the SMH. Tradable bounces should be expected. I think we're nearing the point where that's a likely scenario here.
Okay, and the miners have been decimated. Gold broke about $250 and silver. So what do you do with this?
So I was taught earlier, one of my analysts in my Fidelity years we'd bring up a chart like this and he would say, this just doesn't chart well. And it sometimes charts make a ton of sense. And I would argue like the charts of energy and others, have been fairly consistent. Arguably, even the S&P has made a lot of sense when you think about this rotation from, optimism to pessimism or accumulation to distribution. If you look at the GDX, we're at the same place we were 2 years ago. Right? This is a 2-year chart. we've gone nowhere. This is a big consolidation phase. The chart of gold has come off quite a bit. And, a lot of people think when, inflation is a huge problem, that obviously gold is going to work. And I've certainly been guilty of that as well. But you have to remember, it's a little more about real yields, right? It's about real rates. It's not just about the nominal rates, what the 10-year yield is doing. It's what that is relative to inflation. And if you look at like the tips, for example, they're sort of in a pretty good downtrend, and that's why gold is going to go down. Gold's denominated in dollars, so if the U.S. dollar is doing what it's doing, it's hard to expect gold to rally from here. So at this point, if you're buying gold stocks, or if you're buying gold, it's a mean reversion bet, assuming we're at the lower end of this range, and it's probably come down enough. I don't mind that outlook. I think that's a reasonable expectation. So it's interesting with a lot of these charts, they've had really good runs, and I always talk about mean reversion, right? There's been enough of a run that enough people recognize there might be an opportunity, and you get a bit of a reversion to the other side. And the danger of that, by the way, not to completely go off the rails, but the danger of that thesis is something like cannabis stocks, which have just been in a downtrend consistently. So, just because something has gone down a lot, that on its own should not be your investment thesis. So if you hear yourself saying, I should buy blank because it's gone down a ton, that is a bad thesis. Right? If you can support that with other things, as in it's reaching support, there is some macro thesis that would allow you to for it to bounce higher. I think that makes sense.
Can you think of one fundamental or technical reason to buy this chart?
So not really. I mean, I think in terms of the fundamental reason, I think it's a long-term thesis. I think if you're buying cannabis here, you're buying it, you're probably buying Bitcoin as well. You buy into the idea of blockchain and you like the long-term opportunity, and overall you're probably getting in at a fairly low price. I could get that argument. I own cannabis in a retirement account because I'm not planning on touching it for a long time. And I think at these levels, that is a reasonable long-term bet, because you see the potential there. But from a purely technical perspective, no, this is not the type of chart you'd want to be buying, because for me, I'd be looking for signs of accumulation, right? Signs that buyers are coming in.
Got to stop going down first. Right?
Don't confuse the bottom of the page with support, is what I was taught early on. I think that's absolutely right. There have been a number of times when you could argue that cannabis had gone down plenty, and it never really reverts. You need to see that reversal, and on ETFs like YOLO or MJ, and the bigger names like Tilray or Canopy Growth, and you're not really seeing those at all yet.
I suspect that the difference, or do you differentiate between the U.S. cannabis companies and the Canadian?
I've become, since moving to the Pacific Northwest, where cannabis is a lot more part of the conversation, I've become a little more fluent in the language and where it's at, and absolutely. So I mean, the U.S. market obviously fairly underdeveloped and fairly fragmented, and in Canada, you obviously have a lot more of a public market. You have a lot more of a secondary market to pay attention to. So a lot of the ETFs, a lot of the names you're looking at are Canadian names, but still overall not a great space from a technical perspective.
Okay, and I can't think of another space we haven't covered. Anything you want to wrap it with? You probably came in here with some ideas and I distracted you.
No, no, not at all. I mean, I would, and again, I think if you're looking at this, I'll share a couple charts of that. First off would be, a classic technique to sort of figure out where a bottom might be. And I'm often asked in this environment, just like when the market was moving consistently to the upside, right? Where do you know the uptrend is over? And the opposite here, I will give you three charts that I would be looking at to determine when a bottom might be. The first one's this one, and this is called Dow Theory, and this is what I've adapted Charles Dow's work from 100 plus years ago. It's what I call a new Dow theory. It's looking at the S&P and the NASDAQ composite. So the S&P representing the old economy, the NASDAQ composite representing the new economy. If these things are both making new highs, as you saw in November of last year, the trend is positive, right? The old and new economy all sort of moving upward together. When one of them makes a new high and the other one does not, which is what you saw at the end of last year, that tells you it's called a non-confirmation. That tells you that part of this story is not continuing to play out. So the old economy making new highs, the new economy failing to confirm that. Then you get a bearish confirmation when both of them start making new lows. And in the last couple of weeks, we've gotten yet another bearish confirmation. So, if you ask me, what would I need to see to be less bearish? I would want to see one of these making a new low and having it not confirmed by the other one. And as you can see, this week gave you none of that. It gives you more of a bearish confirmation, telling you that we're not there yet. So at some point, one of these will most likely make a new low.
Back
the other
over
one will
4,100 would give you a little bit more confidence in the S&Ps.
That's exactly right. And so at this point, it's telling me, as opposed to be looking for a bottom, it tells me to be bracing more for a risk-off environment for a little bit. The second one I would say would be looking at this chart. This is the percent of stocks above their moving averages. So we're looking at the S&P 500 here at the top, and then we have the percent of S&P members above their 200-day moving average, which is currently around 30%. The percent of S&P stocks above their 50-day moving average, which is currently around 17%. So while there are bright spots out there are places like energy and consumer staples, right? Things like TAP that are having these nice rotations higher, which I think are decent bets in this environment. The average stock is struggling, right? And so you need to see breadth indicators like this turn more positive. And I heard you or Blake or someone was mentioning capitulation. I heard it as I was bringing up the Zoom room.
People like to say it.
Yeah, it is a fun word, right? If you think about it, though, when you think about capitulation, that's like, for lack of a better phrase, it's sort of this puking out. It's like the last seller has now sold and no one else is left. And so all of a sudden this buying can just come in, and buying pressure can sort of overwhelm things and push them higher. If you look back at like 2008, 2009, you can see that this indicator at the bottom, percent of stocks above their 50-day moving average, often gets down to zero and sits there for quite a while because literally everything's going down. The percent of stocks above their 200-day in major bear market phases has gone down to single digits and even to zero at times as well. So while it feels like they've gone down a lot, which they have relative to the last year or two, if you look at bear market phases, they're not even near the point where markets have bottomed out before. And that's when sort of everything's coming off. When people don't even want to buy an energy stock because they don't want to buy an equity at all, that we're not there yet. And I think if we would get to that point, that's when you'd see these indicators really capitulate. And I don't think we're seeing it yet. The last one I would put, and then I'll be done, is this one. This is looking at the relative strength of consumer discretionary versus consumer staples. Wow. It reminds you a lot of the S&P and NASDAQ charts. So here we're looking at cap weighted, the XLY versus the XLP. At the bottom, we're looking at the equal weighted versions of those ETFs. You mentioned how I've been sort of giving more of a bearish take on things. And that really started, earlier this year, because if you look, these ratios both topped out in November. That's the last time they were confirming that the trend was healthy. From there, it's been the relative defense of staples over the relative offense of consumer discretionary. Both of these ratios have made new lows again in May. 12-month plus lows. These would have to stop going down for me to be less negative on the overall trend at this point. So all of those sort of major indicators, the major index trends, the offense versus defense within consumer, and the breadth conditions are not suggesting a bottom yet. So, and that's why I think bounces at this point, you think of them as tradable bounces. Those are bounces to be sold, not bounces to be buying into, because I think there's still a lot of negativity that has been yet to play out, most likely.
And what's different is, at least in my experience, unless I'm having a memory issue, these multi-hundred handle swings within a day for the S&Ps. I don't think I've ever lived through that, and I've seen a few things.
Yeah, the volatility is not going down, right? The VIX is sitting comfortably above 30.
Okay, so that's a question. Why is the VIX stuck? It feels like neutral or grinding, while the market's a lot lower. VIX hasn't really caught fire yet.
Yeah, so
it's orderly.
I tend to think of volatility in terms of volatility regimes, meaning there's a period of time where the VIX settles into a certain range, and then things change. And if you look at the last couple of years, you can define the phases of market activity by the ranges, right? So 2009, relatively low. You have the big spike in February, March, where the VIX got above 80 for the first time in a very small number of observations where the VIX is anywhere near that level. Then you kind of settled into this elevated VIX with between 20 and 40. Then all of a sudden, middle of last year, things got really straightforward. The S&P in a nice uptrend, volatility very low, the VIX between 15 and 25. Last 6 months now, we're in the new volatility regime where it's really 20 on the lower end, 30 on the upper end, right? So if you just over the last 6 months bought every time the VIX hits 30 and sell every time the VIX hits 20, you did pretty well just trading these bounces. I would argue we're in the process of creating sort of a new volatility regime. I wouldn't be surprised if it starts to look more like maybe the second half of 2020, which is elevated volatility, bigger price swings as people are trying to make sense of things, as people, start to embrace the fact that we're in a downturn. This choppiness in the elevated VIX is people not understanding how bad this could get and starting to think about risk assessment. And
they will on closes over 40.
Well, I was going to say, right, at some point it starts. I mean, I think the VIX gets above 40, which is the purple line here. That's when people really start to, I think that's when you get to this acceptance phase, when people sort of get in the fetal position and get really defensive, where it's not happened yet. But it's getting closer. And I think the VIX might be an interesting chart to watch. The fact that it didn't just go right down after it broke 30 and that was it, tells you the fact that this is most likely more of a sustained move to the downside.
David Keller, everyone. And this is a guy who was not a perma bear before things shifted. David, and he's not a revisionist, where, he doesn't forget what he said if it didn't work out. So David, best place for people to follow you besides Twitter at DKellerCMT?
No, I appreciate it so much, Dale. And it's awesome to be with you. As always, it's a pleasure to chat with you. And I hope I can get you back on my show here at some point. I host a show called The Final Bar on Stock Charts TV. It's the closing bell show every day. And I welcome you guys visiting me there. And then marketmisbehavior.com is my website. Yeah,
that's the naughty side of Dave. All right.
It's the naughty side of your investment process.
He goes from the bar to misbehavior. So, so anyway, you may think David's a choir boy. Anyway, David, really appreciate you being with us today and sharing your views here. I highly respect your work and your giving spirit to share it all the time with people.
So appreciate it, Dale. Have a great weekend. Thanks again.
I root for you, bro. So have a great weekend, and I'll contact you on Twitter, and we'll keep things going.
Sounds good to me.
All right, David Keller, everybody. We're in a bear market, but you could trade both sides, but realize that they're bear market rallies. That's the takeaway. And have a great weekend. Don't just worry about your P&L. Enjoy the people you care about. Tell them how you feel. Recharge your battery. And while the markets are closed, get your plan together for next week so you're not just reacting to the market, but you have a plan to react to. So that's a wrap, everyone. Cheers to you, Darren, Dave, and have a great weekend, everyone. Don't just count your pips, count your blessings. Adios. You too, Paul, Sinatra, all my trading warrior brothers and sisters. Thank you for hanging out with us. You're welcome, Paul.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.